If you were on an ACA plan last year and your monthly premium felt totally reasonable, and now your tax software is basically saying you owe $3,000, you're not alone. This is one of the most common gotchas for folks on ACA health insurance. Everything feels fine during the year, and then tax time shows up with a surprise bill. In this video, I'm going to explain why this happens, the exact forms involved, the three main reasons people get nailed, and then the simple ways to fix it now and prevent it next year. And I'll give you a quick 60-second check that catches the most expensive mistakes. All right, here's the key point. When you get an ACA subsidy during the year, it's not final. It's basically an advance based on the income you estimated, specifically your modified adjusted gross income or MAGI. Tax time is when the IRS does the final math and settles up what you estimated versus reality. The form during the settling is Form 8962, and it uses your Marketplace Form 1095A. Think of it like this. The Marketplace gave you a monthly discount based on your income estimate. Now the IRS is checking what you actually made. So if you got too much of a discount, you pay some back. And if you got too little of a discount, you get the difference back. And depending on your income, there may be limits on how much you have to pay back, but don't rely on that without checking. Early retirees get hit more often with owing money at tax time by taking too large of an ACA premium credit or subsidy because, well, our income can be a bit lumpy. What I mean by that is you can have a low income year until you sell investments, realize capital gains, do a Roth conversion, take a bigger IRA withdrawal, pick up some side income, or have a big dividend year, or basically anything that generates income. So yes, early retiree income has the potential to be a little lumpy. And one more quick note, if you took advance credits during the year, but you don't reconcile them on your tax return using Form 8962, the Marketplace can stop letting you use advance credits next year. So even if you don't owe money back, reconciling still matters. So let's now go into the exact reasons why people get hit with a payback when filing their taxes. First and most commonly, just like we've been talking about, your actual income ended up higher than the estimate you gave the Marketplace. Maybe it was a one-time event, maybe it happened late in the year, but either way, the credit is based on the full year and it gets recalculated using your final numbers. Second, a totally reasonable choice can backfire, taking the full credit up front every month. That lowers premiums during the year, which feels great, but if your income moves around, it raises the odds you'll owe money back when you file your taxes. Third, the 1095A can be wrong, or you might be using the wrong version. If the 1095A is off, the result can be off. And just so you don't think I'm being dramatic, back in the early ACA years, there were very public waves of incorrect 1095A forms that had to be reissued. Today, it's better, but errors can still happen, so I treat this as a required 60-second check, not a paranoia thing, and this is backed by both the Marketplace and the IRS, which currently do advise to review your 1095A for accuracy before you file, and I agree, it's definitely worth the quick check. So the immediate question you're probably having now is, okay, if my 1095A is wrong, well, how do I fix it? I'll get into that in just a sec, but first I think it helps to know the timing. Your 1095A is usually available in your Marketplace account sometime from mid-January through early February. Many marketplaces also send a paper copy by mail by mid-February, but if you chose paperless delivery, it might only show up online or in your Marketplace secure inbox. Now here's the important part. A corrected 1095A can show up after the first one posts, sometimes weeks later. So here's the best practice. If you're filing early, do one last check in your Marketplace account right before you officially file. Personally, I'd rather file a little later than amend later due to a corrected 1095A. So here's what you do. Log into your Marketplace account and download your 1095A. If you see corrected, use that one and ignore the earlier version. And even if you don't see the word corrected, give the 1095A a quick check for accuracy. Make sure it makes sense to you because you know who was covered and which months you had covered and what subsidies, also known as premium tax credits, you received. If anything looks off, wrong people, wrong months, weird dollar amounts, pause right there. This is where you contact the Marketplace and request a corrected 1095A. If you're in a healthcare.gov state, that usually means calling the Marketplace helpline or using the support options in your Marketplace account. If you're in a state-based exchange, you contact your state Marketplace. When you call either Marketplace, be specific about what's wrong. Wrong covered months, wrong covered people, or wrong dollar amounts, for example. Ask them to issue a corrected 1095-A if needed, because that corrected form is what your tax return needs to be based on. Once you have the corrected 1095-A, you use that to complete Form 8962, or your tax software will do it for you using the corrected numbers. Filing with the wrong 1095-A is how people end up paying back a credit they didn't even actually owe. And if you already filed and then later discover you had a corrected 1095-A, or you catch a mistake later on it and then ask for a correction, you're not doomed. It usually means you'll file an amended return with an updated Form 8962, so the credit is recalculated using the correct information. Now, if you're staring at a big paycheck number right now, here's the calm process before you assume your tax software is correct. First, make sure your 1095-A is actually good to go, newest version, no corrected form sitting in your account, and the basics match reality, the covered people, the covered months, and the dollar amounts. If anything looks off, stop and get it fixed with the Marketplace before you go any further. Second, sanity check your income number for ACA purposes, because this is the part people misunderstand. The Marketplace credit is based on the household MAGI you estimated and reported to the Marketplace. And the big idea is simple. All those things that generate income and increase your MAGI account: capital gains, IRA withdrawals, Roth conversions, dividends, interest, and side income that you may be earning. And if you want a full walkthrough of what MAGI is and how it works, listen to my video titled ACA MAGI, How to Calculate and Manage It for Big Savings, and download the free Excel template that you can use to calculate your MAGI and help you estimate it during the year. I'll put a link to both in the description and a link to the video as well on the end screen of this video. So when you owe money at tax time, ask yourself one question. What happened last year that you didn't include in your Marketplace income estimate? Did you sell investments to fund spending? Did you harvest gains? Do a big Roth conversion? Pick up unexpected income? If yes, that's usually the reason you have to pay money back. Okay, now the prevention plan, because this is what actually matters going forward. You really have two levers. The first lever is updating your Marketplace income estimate when your year changes. If you do a big Roth conversion, realize a big gain, or pick up some side income, for example, don't wait until you file taxes and then be surprised you owe money. Update the income estimate by logging into the Marketplace and updating your application so the remaining months adjust and you don't over-receive the credit. The second lever is choosing how much credit you take in advance. If your income is stable, taking the full credit can be fine. But if your income is lumpy, like we talked about for most early retirees, one simple sleep at night move is to take less credit up front. You might pay more monthly, but you reduce the chance of owing a bunch of money later. And if you qualify for more credit based on your final numbers, you'll get that when you file. So here's the best move going forward. Before you do anything that increases income, all the things that could do that, like a Roth conversion, realizing capital gains by selling investments in your taxable brokerage account, taking a larger pre-tax retirement distribution, any of those things, ask yourself, will this change my Marketplace income estimate? If yes, either update the Marketplace or reduce the credit you're taking in advance. And you also have to be really careful about moves that increase income, especially in 2026, since we no longer have the enhanced subsidies, because now there is a cliff when your MAGI, based upon household size, goes over 400% of the federal poverty level, or FPL. When that happens, you can lose all subsidies and have to pay the full monthly premium. For more info and ways to control your MAGI, be sure to listen to my video titled ACA Premium Shock, Pay Less All Year. I'll put this video on the end screen and a link in the description, and also download my free ebook that's a companion to this video and goes into even more detail. And I'll also put a link to the FPL tables by household size so you can see the different income levels by household size to stay under 400% of FPL. Now, if you already owe this year or discover you do, don't panic, accept the math for what it is, a reconciliation. And if you do owe and you can't or just don't want to pay it all at once, Deal with it head on. The IRS has payment plan options. The worst move is ignoring it. And here's the takeaway. ACA subsidies are reconciled at tax time. If your income ends up higher than projected, you may pay some back. Your best defense is keeping your marketplace estimate updated when the year changes. And if your income is lumpy, consider not taking the full credit up front so you're less likely to get a nasty surprise later. Before we go, I have one last freebie to mention to you. Download my 12-step early retirement planning checklist, a practical, easy to follow guide that walks you through everything from calculating your FIRE number to building a tax-efficient withdrawal strategy. Well, that's all for today. Thank you so much for watching and make the most of today.